Hello everyone and welcome. Super sorry for running a touch late. My friend and I were having some difficulties with the sound on the webinar, but thank you for your patience and good to have you all here now. So by way of an introduction, I am Toby Johncox. I'm head of mortgage sales for Enness. Enness is the world's leading high net worth and ultra high net worth mortgage brokerage with offices in multiple jurisdictions globally. And today I'm joined by Carlton, a great friend of the firm and passionate insurance specialist, CEO of Capital for Life. Capital for Life being a life insurance and premium financing firm for high net worth and ultra high net worth clients. They can organise life insurance, including global term, whole life and universal life insurance for clients in over 200 countries. So in terms of businesses, our lines and our interests align very nicely. Today we'll be talking about the use of life insurance as a form of planning to help you protect that hard-earned wealth that you have generated for yourself and for future generations. At the end of the webinar, there will of course be a Q&A. So I think if you can see on your screens, there's a Q&A feature. If you'd like to add any questions there, we'd be more than happy to answer them at the end. So Carlton, thank you for joining me today. It's much appreciated.
It's a pleasure, Toby. We got there in the end with the audio. We're only sitting a couple of miles apart, but anyway, we're there.
Quite exactly. I think in this new world that we've joined, the sort of virtual world, it's inevitable that eventually. I mean, I've done almost, I guess, 10 or so webinars now, and we've been lucky so far. So I was due a bit of a crisis. So look, we're going to discuss life insurance. I think if we start off by just talking about what life insurance is and really where it fits in the IHT planning world.
I apologise, Toby. My headphones. Okay, my headphones are now back. I'm sorry.
We're rocking
okay,
well.
so
no, it's all good fun. So where does life insurance fit in this sort of planning world of inheritance tax, and what types of life insurance are there?
So most countries in the world charge inheritance tax or wealth tax. So that's one of the things to be aware of. You'll be very aware, Toby, yourself, that particularly in the Middle East, for Middle East clients, they're not used to inheritance tax. The GCC, the area of the Middle East, doesn't have inheritance tax. And so this is something that particularly clients here are getting used to. But certainly for mortgages and properties held in places like France, Spain, Portugal, and of course the UK, there is wealth tax to pay. And wealth tax really occurs upon the passing away or the death of the owner of that property. And that's what we're really talking about today. It's how to help those clients, how to prepare, obviously, preparing for the worst, but also preparing to make sure that they can pass on the assets, their property to their children or their beneficiaries if they want to.
Yeah, absolutely. And I mean, that varies globally, right? The levels of inheritance tax, the various ways it's charged, really varies jurisdiction to jurisdiction. Slightly selfishly, we've organised the webinar in a form that means those jurisdictions are the ones that Enness generally focuses on from a mortgaging perspective and how that works with wealth planning. So why would you use, though, life insurance as a way of planning for wealth tax, sorry?
Life insurance has really come to the fore, particularly over the past few years, so if we just focus for a moment on UK property, up until 2017, the usual form of planning for holding UK property for a non-domicile, but potentially UK resident, in other words, someone who wasn't born and wasn't naturalised in the UK, was through an offshore trust or an offshore company. This avoided them having to pay UK inheritance tax on the property. And then you may remember back in 2017, we had what's called de-enveloping, which is one of those great UK tax terms. It's like, what does that mean?
Yeah, it sounds very sexy, but in reality, it's just
that's right.
Not, yeah.
It's not in the slightest. It just means to say that you have to pay tax. De-enveloping is probably as interesting as they could make it sound. So in summary, that meant that in 2017, properties became fully exposed that were held in offshore trusts and offshore companies to UK inheritance tax. And so, yeah, life insurance came to the fore really over the past few years in particular, because of this need to cover the UK inheritance tax position, which after all the allowances is charged at 40%. So for example, if we had, it is a very high amount, and it's a similar sort of amount in many countries. I think we looked at Portugal, but that was a while back. That was at 34%, if I remember. France has changed its wealth tax recently, beginning of this year. And again, number of allowances, but the UK is obviously 40%. And so, for example, if you had a client with a £10 million London property, that could be held in an offshore company, or it could be held in their personal own names. That's still going to be charged now. There's an inheritance tax charge of £4 million against a £10 million property. So it's a big chunk of money, and people should plan for it.
Absolutely. And so life insurance, and what are the simple terms for simple people like myself? What are the general types of life insurance that one might look to take?
Broadly speaking, there are two types of life insurance policy. There's a term policy, which is, as it suggests, it's fixed for a set amount of time. For example, 7 years, 10 years, 20 years, and you just pay the premiums. You pay the cost, if you like, to the insurance company every year, typically over that number of years, and that gives you a benefit, or your family a benefit, if you should pass away. So, for example, you might have a 10-year term, covering you for, say, £4 million, and it might be costing you, as an example, it might be costing you £130,000 a year for each of those 10 years, as an example. The other version is whole of life, and that is literally doing what it says on the tin. It's insuring the rest of your life, and that £4 million is going to be insured, whenever you pass away, effectively. So you might be passing away at 90, that cover will still be in place. So the upsides of a whole of life insurance policy is it will cover you until the day you pass away, whenever that is, for the rest of your life. A term insurance policy is generally there to make sure that you've covered for a specific period of time. I think, in fact, your guys' cases, it's typically for the period they're holding a mortgage. They might have a 5-year mortgage or a 10-year mortgage. So you would typically take out a 5 or a 10-year term policy. Although later we'll see that there are benefits of having a whole of life policy as well. Yeah, and there's super exciting case studies that give the je ne sais quoi to what we're talking about today. So look, you mentioned earlier the de-enveloping thing, which we might touch on a little bit more detail shortly, but that's holding real estate or other assets within a structure. Can you hold the insurance, your life insurance policy, within a structure, or is there a normal way of taking that insurance? Yes, that's a good question. So for all estate planning purposes, somebody should typically hold a policy, or buy and hold a life insurance policy inside a trust. Now, again, there are, as usual, complex tax rules around that. If you're a UK domicile and a UK resident, there's one set of rules. And if you're a non-domicile UK resident, there are another set of rules. So it's probably pretty difficult to get into all of that during this webinar. But needless to say that everyone should hold a life policy inside a trust, because the payout, what you don't want to be doing is getting the policy paying out, let's say this £4 million, and then all of a sudden your estate has to pay inheritance tax, 40%, on the £4 million, because that's inside your estate as well as the property. That doesn't really solve, or doesn't solve as well as it should do, the problem that you're trying to answer here. So broadly speaking, people should be holding this in trust. Again, a number of trust companies, which we and obviously yourselves at Enness will work with, to make sure that those policies are structured in the right kind of way, and to make sure that the children or the beneficiaries also benefit in the right way from the policy payout.
Yeah, super. And I guess with it being in trust, it's pretty well defined. There's a speed at which things can be organised, and it sits outside of the sort of bureaucratic red tape potentially of any sort of probate. So it's peace of mind holding it in the right structure. Now, to talk on de-enveloping just a touch. So you mentioned 2017, the rules changed. It comes up all the time in conversations that I'm having with clients. They don't even realise that such a thing exists. Because, like you said, in the region or further afield, maybe it doesn't exist. But also because 4, 5, 10, 20, 100 years ago, whenever they bought the property and put it into structure, they were given this advice that this is how to protect yourself from the inevitable tax issues. De-enveloping in simple terms is just the removal of a property held or an asset held in a company to move into your personal names. You would then employ, if I'm right, and you can add some meat to the bone, you would then take a insurance policy, which you can do either in the company or in the personal name. But by taking it in the personal name, it's more efficient, or how does that exactly work?
Yeah, so you've got some choices as well to make. There's the other acronym is ATED, which is the annual tax on envelope dwellings. So you've got a choice of paying that if you'd like to. Again, that can be expensive. So one of the things that we do for clients is let's do a tax analysis. Is it cheaper to pay the ATED or is it cheaper to take out a life insurance policy? So on a large £20 million plus property, for example, ATED currently is sitting at just below £250,000 a year. So the equation is, should we be paying ATED or should we take out a life insurance policy, for example? I think the thing with the life insurance policy, as you'd probably expect me to say, but it's a fair thing to say, is that there's been a number of changes of rules around how you are holding property and how tax is charged on it. It's a moving feast, and leave that best to our tax colleagues. But the one thing you can say about life insurance is it's non-contentious. You can't really ever see it being legislated against because it provides a big lump of cash for the family or the beneficiaries to pay the tax bill. So whichever way you like to look at it, you can't really see the government saying, no, we won't accept life insurance as a payment for the tax that you owe. So we think from that perspective, it's a clean and straightforward solution.
And relatively future-proofed as well, on the basis that it sort of gives a lily both sides. So in that then, so that's life insurance in a sort of roundabout whistle-stop tour, and you know, I don't think anyone really wants us to sit and bang on about the minute details of life insurance on a webinar. But I think what would be interesting is to talk through 2 case studies that we've put together and put a little bit of context into what we're discussing. Now, if technology allows me, this is the first time I've used a presentation for a webinar. Hopefully everyone can now see that. So we've got 2 case studies. One is, I guess, what I would traditionally see as, or the standard sort of Westernised or UK member would see as a way of using life insurance. And then maybe the second one, Carlton, you'd agree, is a slightly more sophisticated way of working life insurance and mortgages and other planning into making and meeting someone's requirements. So do you want to hand it over to you, Carlton? You can sort of run through the first case study.
Yeah, thanks, Toby. Okay, so this is actually the same couple. It's the same family that we're talking about, but we're just trying to show what basic planning could do or would do, and then take it on to the next level, as you said, Toby, about looking at their, if you like, looking at their estate planning in a more wider context, a more holistic context. So on this first slide, we've got the couple, their husband and wife. In this instance, they're French nationals. He's 50 and she is 48, and they've got a young family, so that's important to protect. They've got a London property already. It's valued at 7 million, and they've got no existing mortgage on it. So that is a nice asset to be holding. They are non-domicile, but they're currently resident in their house in London, in the UK. So one of the things that they want to do is to protect the family against inheritance tax. So this is a fairly straightforward solution, as you're saying. So £2.4 million is the UK inheritance tax liability on the property if they pass away today. And we've also made the husband, he's the main breadwinner. So the 2 things they want to do is cover the current UK inheritance tax position, but also one thing that I think that people should also consider is what happens if they continue to hold that property over the next 10, 20, 30 years even. So there's going to probably be a rising UK inheritance tax bill if London property continues to rise in value, which over the long term, I think probably most people would expect it to do that.
Let's hope so. Let's hope so.
Indeed. Okay. So on to the next slide. So what we're just looking at here is a simple solution. So if the couple just remortgage their property, just on a very gentle 15% LTV or 15% loan to value, and take out 1.1 million pounds of equity from that property, they then use that 1.1 million to buy an insurance policy, and that will then give them more than enough cover that they're looking to achieve here. Because if the husband passes away, in the policy that we priced up here, his estate will receive 3.9 million. So that's the inheritance tax cover they're looking for, plus the return of the premium in itself. So there's plenty, there's plenty of cash around if the family should need it. I just want to point out, we do recognise the fact that if the property is held in joint names, it would pass to the wife, and therefore inheritance tax wouldn't be payable upon the first death. So we do know that point. It's difficult to get everything into a case study here.
Absolutely.
But anyway, the money, that 3.9 million, could be used to either pay the inheritance tax liability if both the husband and wife were to pass away, or if the husband just passes away, then the whole lot obviously passes to presumably the wife to take care of the family, and then she could put some of that aside for maybe a future inheritance tax liability, or indeed take out her own policy. But the last, if you like, short spreadsheet here is probably the interesting bit. So he's age 50 now, so he's insured for 3.9 million. But over time, the value of the property rises. So we've taken the spreadsheet out, and this policy, if you look at age 90, it'll pay out 7 million. So that's taking into account some fairly decent rises in future rise in property values. Because it's all very well, if you like, dealing with the inheritance tax position today, but what about the future? Because we'll assume this family have no intention of leaving London. So over the longer term, as I said, you would expect that inheritance tax bill to rise because of the rise of London property. So that's a fairly straightforward case.
Just on that, with the increasing coverage or the increasing benefit, is that pegged to a particular index, or is it is there an assumed increase annually? How does that work?
You can set up the policies, Toby, in a number of different ways, but we've just assumed a gentle, I think that's probably 2.5% or 3% rise annually. Again, we can just do a calculation backwards to see what somebody wants to do, but you can set these policies up within reason, how you want them to look.
Cool.
Okay, so that's the basic case study. So if we move on to the second version of this case study.
So this is where there's a little bit more thought goes into things. It becomes a little bit more interesting from a planning perspective, I think.
We hope so. I'm sure the audience will tell us whether they're interested or not. So we have exactly the same scenario here, but this time we've dug a little bit deeper into what all of their goals and what they're looking to achieve. So you'll see in the blacked out areas at the top, all those details are identical. But now we learn that he's got a current income of £450,000 a year from his job. He's got a private bank portfolio of 4 million, and his major concern or expenditure is on school fees, perhaps unsurprisingly, and he's also saving any excess income or the excess income for retirement, because he's 50, and as we'll see in a second, he wants to retire at 60, preferably. He is the main breadwinner. And of course, he wants to cover the UK inheritance tax, which is 2.4 million on the property as of today. And he also has the private bank portfolio, which we need to take into consideration now, of 1.6 million inheritance tax liability. So all of a sudden, we realize we're no longer just covering his inheritance tax position on his property, but we've now got a private banking portfolio to take into consideration as well. Now, this is where it gets slightly more exciting, I hope. We'll see. So he also wants to take an income at £250,000 a year in retirement, which is 10 years away in our case study. He's not sure that the private banking portfolio currently will afford him that level of cover. I think if my maths is correct, that's a return of just over 6% per annum, which it could do. But he would like to look at other options here as well. And he, of course, him and his wife are French. They would like to buy a property in Paris, maybe an apartment, and look at using that as a buy-to-let, and maybe also using that as a way of topping up their income. and also have a foothold back in their home country. So that's the extra detail we know about these clients now. So we've got a IHT position of 4 million. He's got plenty of excess income, which can be used to pay the new mortgage interest, because at the moment, you remember, he hasn't got a mortgage at the moment, but we're basically recommending he takes out a mortgage. In this case,
we know a few good friends that could help him with that.
That's right, over there at Enness.
Exactly.
He wants to take advantage of the cheap finance, and he believes cheap finance is going to remain in vogue for a while. He also wants to consider the future rises in the property value, the private banking portfolio, and estate tax there. He also likes the idea of diversification of his portfolio as well. And there's something else that we found out. He would also like to, if it's possible, to pay for his grandchildren's education and take care of some estate planning opportunities at the same time. So if we move on to the next slide, we will have a look here at what we did. So we're going to take out 4.8 million, which is 70% LTV against his £7 million portfolio. We're going to take out 4.8 million pounds, and we're going to put that into a offshore whole of life insurance policy. We're going to also have the increasing death benefit because that's important because of the reasons we talked about earlier. So the insurance policy payout is now 12.2 million. And if he passes away, obviously that will be more than enough for his family, you would think, to live on, because his current UK IHT liability is only 4 million. Again, the liability may not come until the second passing of the wife, but you can see hopefully the logic of the planning that we're doing here. And this is where it gets interesting, because most people associate life insurance with just paying a tax bill. But when you've got a cash value whole of life policy, you can also start to take an income from the policy. So on the modelling that we've done, we can take an income, or he can take an income of £250,000 a year from the insurance policy from the age of 60. So that's his retirement age in 10 years' time. And he can still keep the £12.2 million death benefit. So that is a big change from what most of us in the UK are used to. Normally, we're just used to a guaranteed whole of life policy. Again, until we discussed
that just a few days ago, when we really started getting our heads together to put all this together, it blew my mind. My sort of natural instinct when you talk life insurance, as you mentioned there, is that it's just a sort of monthly payment that you make, and it pays off your mortgage when you pass away, or a very basic level of coverage. But you know, thinking of it as an asset is a completely different way of thinking.
That's right. Yeah, it's definitely an asset. It's an asset for after your lifetime, but in this case, it's an asset during his lifetime. It has lifetime benefits, and I think hopefully you'll be pleased with this last bit as well. So he also wants to buy this Paris 2-bedroom apartment. So from that life policy, you can also take out a loan from it. So in this instance, we're going to take out a small loan from the life policy, which is then his deposit for the Paris property. And then he's going to take out a mortgage, presumably with Enness, for the rest of the value. The loan interest in the life policy rolls up, so that's not repayable. He doesn't have to repay that on a month-to-month or a year-to-year basis. And then the mortgage interest payment, he's going to make that with the rental income from the apartment. And then eventually, over time, the buy-to-let income will pay down the mortgage capital that he's taken out on that, and that will also provide some additional income in retirement. So we've started to hit all of his bases now. And then probably the final slide, and again, we've already covered some of this, Toby, but we'll just go through it for the sake of conclusion. So the estate value, his estate value is now increased from 11 million to 18.4 million because of the addition of the life policy if he passes away. And the London home now becomes, if you like, an asset it's not only his home, but it's also an asset working for him, because the mortgage which he's going to take out on this is now going to provide with the family with cash liquidity. It's going to provide the UK IHT now and into the future. It will pay off the mortgage if he passes away. It'll provide the income of £250,000 a year in retirement. He can do his buy-to-let Paris apartment, which he would like to do as well. And of course, it diversifies the investments further because there's built-in guarantees to the policy. and floors and caps, and again, stuff we won't get into necessarily on today's call, but it's a way of diversifying the existing private bank portfolio and existing cash that he's got. So all we've done here, the quick sort of summary here is we've just taken his client, the client's assets, and we've just remodeled them. We've used the home, we've extracted some equity from that with a mortgage, and then of course the mortgage then allows us to do all these other pieces with it. So I'll stop talking there, and we'll either open up the floor or ask you over to you, Toby, for some more questions.
Yeah, absolutely. I think it obviously super detailed. That everyone who's watching, this is the time to cram in some questions. I think, again, I mentioned it before. For me, the deeper level of planning using life insurance becomes really interesting. Life insurance as a sort of standalone policy is just a product that people are selling all over the place, right? Whereas using it, thinking of it more holistically, understanding everyone's needs, and therefore being able to do all the other things that client wanted, increased his benefits from while alive, but also then, or her, should we say, benefits while alive, but it will also help build, grow, protect the family once everything's done and all things are said and done, should we say. So maybe we were so detailed and so informative, or people are still thinking, but we have no hot questions, which is absolutely fine. Is there anything else you want to cover before we sort of tie things up?
No, I think just to sort of reiterate what you said, Toby. I mean, whole of life insurance can certainly be, we often see that negatively. It just provides a tax liability benefit at some point after our lifetime, and of course that's good, still straightforward, good UK planning. But when you do have foreign nationals or non-domiciles, then you do have the opportunity to look at offshore life insurance solutions. And it's that cash value that can then start to really open up the toolbox for not only financial planners, but give the clients options, as hopefully the case study has shown today.
Yeah, perfect. And there has been one quick question that's flown in, and actually I'm going to ask a question to you, Carlton, off the back of that. So what is the current rate of interest on a mortgage? So look, I think that's an easy but difficult question to answer, in that there's a huge scope of what rates will end up at. The best sort of in-market rates at the moment are sitting around 1.5%-ish plus cost of funds. And right up the top end, you're paying obviously significantly more. So they can be very, very competitive. I think you mentioned earlier, cheap interest rates is a great time to be in the market, looking at fixing or taking advantage of that. One question that comes off the back of that for me, you talked about borrowing against the insurance policy. How does that work? I mean, we're in the game of mortgages. I've never organised any sort of lien against an insurance policy. So Carlton, how does that work, and what are the various costs associated with it?
So first and foremost, this only works with Enness or somebody providing the mortgage in the first place so that the asset of the life policy can be bought. The second point is, of course, you've now released 4.8 million in this case study, and that has all 4.8 million has been used to buy a life policy. That means to say it hasn't been bought with any lending against itself. We could then take that life policy and say to the insurance company, okay, it's got a cash surrender value. Let's say you put in 4.8 million on day one. Let's say the cash surrender value is 4 million. Theoretically, you could borrow up to 100% of the cash surrender value of, let's say, 4 million, and you're earning money inside the policy, so it's going up increasing in value. Again, that's a slightly longer answer, but the policy is increasing in value, and then the insurance company will give you a loan against that cash surrender value, and the interest rate on that will be a maximum of 1.25%. But I think the short summary, Toby, is you're borrowing against the cash surrender value of the policy, and that's where we came out to buying the client having then been able to borrow the deposit to buy the Paris apartment, and then using a mortgage to pay for the rest of it.
Yeah, perfect. And clearly these answers are getting the juices flowing. And another question coming in. So we talked today on UK real estate or UK assets and how IHT can be planned against using life insurance. Is it just the UK, or can they be done in other jurisdictions as well?
These life policies can be done in nearly 200 countries globally. So to give you just a flavour, an example.
Can you name all 200?
No, but the website will do within the next 10 days. But to give you an example, we're doing life policies like this, not necessarily the same concept, but it could be used for the same thing currently in South Africa, Cyprus, Dubai, Saudi Arabia, the UK, and it kind of goes on and on. This sort of planning can be done in many countries, nearly 200.
Yeah, it's amazing. It's amazing. And in similar, obviously there won't be identical structures, but in a similar manner to the way we've discussed it today, presumably.
Yeah, absolutely. This is one way of skinning the cat, which is quite an English phrase.
Yeah.
But there are other ways. You
might skin the goat in the Middle East, eh?
That's right. That's right. Skin the lamb. But they can be used in a number of different ways. We've also we're using at the moment for key persons insurance. You can also use them as part of a pension planning, etc. But today we focused really on the mortgage one because it's using the benefits of it taking equity out of a property, which you guys can handle at Enness, to then use that to then buy the life policy. But there's a number of different ways we can set up the policy. And I think that, depending on what a client's trying to achieve, we bespoke it and customize it to that end from day one.
Yeah, absolutely. And that equity within real estate at the cost that we're talking about is just making your investment work much, clearly in the second case study, much harder for you than it would be just sat as equity within your flat in London or your house in London. So super interesting. Unless there's any further questions, I think we can probably tie everything up really nicely. Carlton, maybe just give people a feel for how they can get in touch and where they can find you.
Yeah, thank you, Toby. So probably just a direct email is carltoncrabbe@capitalforlife.com, or that's probably the easiest one. And then the website is www.capitalforlife.com as well. Or of course through our friends at Enness.
Or the best way to be, referrals is always a better introduction, isn't it? So I think to wind things up, obviously what we're focused on today is utilising your property, mortgaging it to buy an insurance product that really benefits you and looks after everything that you're looking to achieve. Everything's a wide word, but most of the things you're looking to achieve. Life insurance and mortgages, real estate are two sort of products that go really nicely together. And it's something we're certainly looking to build more of a relationship with Carlton and the team at Capital for Life in transacting on and helping with more of our clients. So it's a real pleasure to have you today on our webinar. It's been a while since we've caught up for obvious reasons, but let's look to get a coffee or better in the diary very soon. And thank you very much for having us. To everyone watching, we'll be posting this on YouTube later, so it's available to rewatch because it's obviously on the edge of your seat stuff. And if you've got any questions, I'm at tj@enness.co.uk or through the website at enness.co.uk. So thanks again, Carlton, and we'll catch up soon.
Thanks very much, Toby. Thank you.
Appreciate it. Ciao.